Canadian Mortgages, Part 3 Feet. Your lender may require you to increase your payments so that your mortgage will be paid off within the amortization period you had originally agreed to in your mortgage agreement. With fixed payments, you do not know in advance how much of the principal will be paid off at the end of the term. Adjustable payments. Your payment amount changes if the interest rate changes. A set amount of each payment is applied to the principal, and the interest portion fluctuates depending on changes to the interest rate. If the interest rate goes down, your payments will decrease. If the interest rate rises, your payments also increase. This can make it more difficult to plan your mortgage payments over the term of the agreement, so you need to be sure you can adjust your budget to make higher payments. With adjustable payments, the amortization period stays the same. You can tell in advance how much of the mortgage will be paid off at the end of the term, because you pay whatever amount is needed to add up to the agreed amount. Hybrid mortgages. Some lenders offer hybrid or combination mortgages. Part of the mortgage is financed at a fixed rate and part is financed at a variable rate. The fixed portion gives you partial protection in case interest rates go up, and the variable portion provides partial benefits if rates fall. The portions may have different terms. For example, a hybrid mortgage may include a 2-year term for the variable portion and a 3-year term for the fixed portion. Hybrid mortgages that include portions with different terms may be difficult to transfer to another lender. The interest rates on variable rate mortgages are often lower than unfixed interest rate mortgages with the same term length when you sign your mortgage agreement. This may make variable interest rate mortgages attractive in the short term. However, whether you are better off with a variable interest rate mortgage compared to a fixed interest rate mortgage depends on whether the market interest rates go up or down during your term. Payment frequency. Payment frequency refers to how often you make your mortgage payments. Options include: pay mortgage from less frequent to more frequent. 1. Monthly. 2. Semi-monthly. 3. Bi-weekly. 4. Accelerated bi-weekly. 5. Weekly. 6. Accelerated weekly. Your payment frequency is set when your mortgage is first arranged, but you may be able to change it afterwards, usually without having to pay a fee. Excellent choice. Accelerated payment options. Accelerated weekly and accelerated bi-weekly payments can save you thousands, or even tens of thousands in interest charges, because you will pay off your mortgage much faster using those options. The reason is that with the accelerated options, you make the equivalent of one extra monthly payment per year. Regular weekly and bi-weekly options do not provide the same benefits. Portable mortgages. Porting a mortgage refers to transferring some or all of the terms and conditions and outstanding balance of the mortgage on your existing home to a new property while remaining with the same lender. Homeowners often port their mortgages when they have a lower interest rate on their existing mortgage than is available for a new mortgage. By porting your mortgage to your new property, you can usually avoid prepayment charges for breaking your mortgage contract early. Check with your lender to see whether your mortgage is eligible for porting and whether any conditions or restrictions apply. Assumable mortgages. An assumable mortgage allows a home buyer to take over the seller's existing mortgage along with the property. The terms of the original mortgage must stay the same. In most cases, the lender must approve the transfer as well as the buyer who wants to assume the mortgage. If approved, the buyer will take over the remaining mortgage payments to the lender. Lenders may charge the buyer a fee to assume the mortgage. Important: in some provinces, the seller may remain liable for the mortgage after it has been assumed by the buyer. However, some lenders may agree to release the seller from any personal liability if the buyer meets the lender's qualifications. Cashback. Cashback is an optional feature that provides you with a percentage of your mortgage amount in cash right away. While it can help you pay for things you'll need when getting a new home, such as legal fees or furniture, you usually have to pay a higher interest rate to get a cashback option on your mortgage. The interest charges you will pay due to a higher interest rate could cost you more than the money you receive as cashback. The lender can impose certain restrictions on the cashback. You may not be allowed to use cashback funds as part of your down payment. If you decide to renegotiate, transfer, or renew your mortgage before the end of the term, you may be asked to repay some or all of the cashback amount. Shop around and ask about all the conditions before applying for cashback on a mortgage, or consult your bank or mortgage broker.